Brian Davidson, and welcome to Fathom in Person. I'm here with Will Hynes today. Will Hynes covers the Euro area, and Will, you've written a note about the Phillips curve, and there are rumours that it has demised, but those rumours are somewhat untrue. So what is the Phillips curve, Will, and why do people think it's dead?
Morning, Brian. The Phillips curve refers to an inverse relationship between the level of unemployment in an economy and the rate of inflation. More broadly, it can also refer to a general level of slack, such as the output gap and the rate of inflation. The reason people have been saying that this relationship is either heavily diminished or gone completely is because the substantial decrease in unemployment rates that we've witnessed in advanced economies such as the United States have not been accompanied by a sustained increase in inflation.
So are they right then? Unemployment's gone down, but wages and inflation haven't gone up by very much. Are they right?
No, we don't believe they are right. Based on the research we've conducted here at Fathom, we believe that wage growth has been lower than would be expected given the decrease in unemployment for three reasons. Firstly, productivity growth. People are paid more when they've demonstrated that they can produce more, and this is measured by productivity growth. Productivity growth has been considerably below pre-crisis trends across a range of advanced economies. So this is one of the reasons. Secondly, the labour share, which measures the proportion of national income that is paid to employees, has been steadily declining across advanced economies for several decades, the majority of advanced economies. This has been placing downward pressure on wage growth. Finally, inflation expectations, which play an important part in determining inflation outturns, have been both declining and the volatility of these inflation expectations has reduced. And this has also participated in lowering wage growth.
So productivity growth has been weak, which means the pie is not growing as fast as it used to. And if labour share of income has diminished, then the share of that pie going to workers, going to labour, is lower than it was before. So am I right to understand that you're saying this is why wages and inflation have been so weak?
Exactly. So if we take one of those factors.
And why has that happened? Why has labour share gone down so much?
Okay, so if we look at the labour share in particular, we find several reasons for its decline. Firstly, globalisation. Globalisation has enabled companies in advanced economies to locate production facilities offshore or to import goods that they previously produced domestically. This has reduced the bargaining power of workers and placed downward pressure on wage growth. Other factors such as demographics. In recent decades, we've seen an increase in the global labour force. So this has increased the supply of labour and again pushed downward pressure on wage growth. Finally, a couple of other factors to point out are deunionisation. We see in advanced economies a much lower membership of trade unions, which has decreased workers' bargaining power. And finally, technology. We're all aware of how technology has eliminated some jobs in low and medium skilled industries. As that has happened, an increasing share of total income has gone to the owners of capital as opposed to employees.
So you've listed several factors that have put downward pressure on wages and inflation. So how can we predict inflation going forward? Are there any other alternatives than simply looking at the change in the unemployment rate?
Yeah, so fortunately there are, Brian. We've looked at, for instance, the output gap, and it's the relationship between the output gap and inflation across 17 major economies. We find that relationship...
What is the output gap?
So the output gap refers to the difference between the current level of output in an economy and its long-run potential outputs based on its productive capacity. So in other words, when there is a positive output gap, an economy is operating above its long-run potential, and a negative output gap implies a high degree of slack in the economy when the economy is operating below its potential. So if we use the output gap as a predictor, if you like, of inflation, the relationship is more reliable given the background noise that's affecting the relationship between unemployment and inflation. And this is an alternative tool to use when predicting inflation.
Okay. Tell me then, what if you are wrong, and what if the others that think that the Phillips curve is dead, what if they are right? Can they be right? What do you think about that?
The short answer to that would be no, it can't be right. So let's imagine a world in which they were right. An economy could operate above its long-run capacity indefinitely without generating price pressures. So what would happen? Governments would employ more people, they would pay them more, they would increase public services.
So you're saying that governments could print money, spend money, and nothing would happen?
Exactly. At the same time, central banks could lower interest rates to the zero bound, and they could increase the money supply through asset purchases. If there was no relationship between the level of output in the economy as compared to its potential and inflation, we would see price levels remain unchanged. That would mean that everybody would have more money in their pockets. We would all have higher real incomes without the economy's real productive capacity having increased. That probably sounds a bit too good to be true, and that's because it is.
Well, on that note, thank you very much, Will. That was very interesting, and it was good to hear about your views.
Thank you, Brian.